You've been told a crypto exchange collapsed because of a bank run. The historical record says something more precise happened. You are staring at a withdrawal screen. It says processing. It has said processing for 6 hours. Your money is on an island, a real one in the Bahamas, in a data center behind a beach resort. Somewhere in that data center, a number that used to represent your dollars now represents nothing, not a smaller number, nothing. You refresh the page, the spinner turns. Outside on the actual island, cranes are still finishing a $60 million penthouse complex that this company built for its executives. Inside a spreadsheet nobody outside the company has seen yet, a gap has opened up, not a rounding error, not a delay, a hole roughly $8 billion wide. You don't know that yet, you only know the spinner is still turning. This is where the story usually stops being told as a story and starts being told as a scandal, a pile of tabloid details about penthouses, celebrity endorsements, and a rumpled 30-year-old in cargo shorts who once said he'd give away his fortune. That version isn't wrong, it's just incomplete. It explains the person. It doesn't explain the mechanism. The mechanism is what this is about, not the individual eccentricities of one trader in the Bahamas, but the structural pattern he exploited, a pattern financial history has seen before, with different names, different centuries, and the same underlying architecture. Once you see that architecture, you won't just understand what happened to FTX. You'll understand why a version of this keeps happening, roughly once a generation, in whichever asset class is fashionable at the time. You've been told the crypto industry is uniquely prone to fraud, uniquely unregulated, uniquely full of people who deserved what they got. Set that framing aside for a moment. The dollar amount here, roughly $8 billion in customer funds either misappropriated or unaccounted for, puts this collapse in the same conversation as some of the largest financial frauds in American history, alongside failures that had nothing to do with digital assets. The asset class is incidental. What isn't incidental is the specific relationship between the entity holding your money and the entity betting with it. The real driver isn't a villain. Beneath the headlines, a specific financial logic is operating, one that connects a Bahamian crypto exchange to Amsterdam tulip contracts, a Ponzi scheme in a Manhattan penthouse, and a savings and loan crisis 3 decades ago. The official explanation describes the personality. The mechanism sits elsewhere, in the space between what a company custodies and what it controls. You see 2 companies, one takes deposits, one makes bets. On paper they are separate, in practice they shared a backdoor. FTX was a cryptocurrency exchange, a place where customers deposited real money and crypto assets to trade. Alameda Research was a hedge fund founded earlier, run by the same person, Sam Bankman-Fried. Alameda traded aggressively, using leverage, on the assumption that crypto markets would keep expanding. According to the SEC's 2022 complaint and the Southern District of New York's criminal case, FTX quietly gave Alameda a credit line effectively without limit, funded by customer deposits that customers believed were sitting untouched, available for withdrawal on demand. Think of a bank as a security guard standing between your money and anyone who wants to gamble with it. Regulated banks are required to hold a portion of deposits in reserve and are restricted in how they can use the rest. FTX's terms of service made a similar promise. Customer funds would not be used for anything without the customer's permission. The guard in this case had a second job. He was also the gambler. You notice a company that pays its own bills with a currency it printed itself. FTX created its own token, FTT, in 2019. Alameda held a large position in FTT and used it, along with other FTX-linked assets, as collateral against its borrowing. This matters because FTT's price was substantially set by trading on FTX's own exchange. A firm was borrowing against an asset whose value it could itself influence, then lending the proceeds against customer deposits held in trust. Financial historians have a name for this kind of self-referential valuation. It is a version of wash collateral, an asset that looks liquid and independently priced, but is neither. Charles Kindleberger in Manias, Panics and Crashes, 1978, described how speculative structures often rest on assets whose price is sustained by the very entities that depend on that price, a fragility invisible until someone outside the circle asks a hard question. You watch a single article do what years of due diligence did not. On November 2, 2022, CoinDesk published a report based on a leaked Alameda balance sheet, showing that a large share of Alameda's assets consisted of FTT, the token FTX itself had created. Days later, Binance CEO Changpeng Zhao announced Binance would liquidate its own FTT holdings. That announcement did not create a new problem. It asked a question the structure could not survive being asked. What is this actually worth if nobody defends the price? Customers, reading the same signal, began withdrawing. FTX could not meet the withdrawals because the deposits were not fully there. Bankruptcy followed on November 11, 2022, alongside more than 130 affiliated entities. The mechanism has a name in financial history: a liquidity run against an insolvent balance sheet disguised, until the run, as a solvency problem that hadn't yet been tested. Hyman Minsky in Stabilizing an Unstable Economy, 1986, described exactly this transition: institutions that appear stable because no one has yet demanded liquidity faster than the institution can produce it. The moment demand accelerates, the appearance and the reality separate. You assume the missing $8 billion was stolen in one dramatic transfer. Court testimony says otherwise. Testimony from FTX engineer Nishad Singh during Bankman-Fried's 2023 criminal trial detailed how customer funds moved outward continuously in ordinary-looking transactions: venture investments, real estate in the Bahamas, sports sponsorships including the Miami Arena naming rights, celebrity endorsement deals, and political donations. Singh testified the whole was roughly $8 billion and had been partly obscured by an accounting error that misstated customer liabilities. This detail matters more than the celebrity names attached to it. The fraud, according to prosecutors, was not one heist. It was thousands of ordinary-seeming disbursements that were only fraudulent in aggregate, because each one drew down funds the company had promised in writing not to touch. You picture a single ledger with one glaring red entry. The reality, according to testimony, was closer to a spreadsheet with thousands of unremarkable line items, each individually defensible, none of them individually catastrophic, all of them drawing from the same pool. Singh's testimony described spending on a crypto mining firm in Kazakhstan, a large stake in an AI research company, and a $200 million position in a venture fund run by a well-connected investor, the kind of access-buying behavior that, in isolation, resembles ordinary venture capital. What made it fraudulent was not the category of spending. It was the source: customer deposits that the company's own terms of service said would never be used this way. Adam Tooze in Crashed, 2018, described a similar pattern in the 2008 financial crisis: banks using short-term, supposedly liquid funding to finance long-term, illiquid bets, confident the funding would always roll over. It rolled over until, suddenly, it didn't. Here is what that pattern historically produced, stripped of its Bahamian real estate and its Super Bowl advertisement: a single entity holding both the depositor's claim and the discretion to deploy that deposit, with no independent party positioned to say no. This is where the more important mechanism becomes visible. Traditional finance addresses this exact vulnerability through a specific, unglamorous set of structures: segregated customer accounts, independent custodians, capital requirements, and third-party audits, precisely because regulators learned repeatedly that a single entity holding both functions will eventually use one to bail out the other under stress. Milton Friedman and Anna Schwartz, in A Monetary History of the United States, 1963, traced how the absence of a reliable lender of last resort function and weak custodial separation turned an ordinary regional banking stress event in the early 1930s into a systemic collapse, because depositors had no way to distinguish a solvent bank from an insolvent one until it was too late to matter. X operated outside most of that architecture. It was headquartered in the Bahamas specifically because the regulatory environment there was, by Bankman-Fried's own public description, more accommodating than in the United States. That choice of jurisdiction is itself information. Financial history shows a consistent pattern of capital and corporate structures migrating toward whichever jurisdiction imposes the fewest custodial requirements, a dynamic sometimes called regulatory arbitrage. The incentive is straightforward. The more discretion an operator retains over deposits, the more optionality that operator has, and optionality has value, even when, especially when, the depositor does not know it is being spent. Here is the pattern you've already noticed, stated plainly. An institution holding your money quietly used it to fund its own bets, and collapsed the moment enough people asked for it back at the same time. Financial historians and regulators call this a version of the custodial commingling problem, and its most extreme form, where new deposits are used to sustain the illusion that old obligations are being met, carries the name of the man who ran it in 1920s Boston: a Ponzi structure. FTX was not strictly a Ponzi scheme in the classical sense, because the underlying business was real and the assets it held had genuine market value at various points. But the pattern it shared with Ponzi's postal coupon scheme, and with Madoff's fabricated statements, is the same: liabilities to depositors that exceeded the liquid, verifiable assets available to meet them, concealed by continuous inflows that made the gap invisible until inflows stopped. The last major time a comparable structure appeared at this scale was Bernard Madoff's investment fund, uncovered in December 2008. Madoff had operated for decades, reporting steady, implausibly consistent returns, while in reality using new client deposits to pay redemptions to existing clients. The fund's collapse was triggered by the same mechanism as FTX's, a wave of redemption requests, driven by the broader 2008 financial panic, that the fund could not meet because the deposits were never invested the way clients believed. Anthony Scaramucci's description of bankman-fried as the Bernie Madoff of crypto was, in this narrow structural sense, more precise than it may have sounded as commentary. How it ended both times: forced liquidation, a court-appointed administrator tasked with recovering assets for defrauded creditors, criminal prosecution of the operator, and years of litigation attempting to claw back the money that had already been spent. Madoff was sentenced to 150 years in prison in 2009. Bankman-Fried was sentenced to 25 years in March 2024 and ordered to forfeit $11 billion. What it tells you about the present moment: the pattern is not specific to crypto, and it did not end with FTX. Any market experiencing rapid growth, light regulatory oversight, and strong social proof from public endorsements creates the same conditions: an environment where a custodian can quietly become a speculator, and where the only reliable warning sign historically has been the structural one. Does this entity control both your deposit and its own trading book, with nothing independent standing between the two? Myth: this was primarily a crypto problem. Reality: crypto was the asset class, it was not the mechanism. The mechanism, commingling customer deposits with a proprietary trading book, valuing collateral using an internally controlled price, and expanding until a liquidity event exposes the gap, has appeared in currencies, mortgages, and plain cash deposits going back centuries. Why it's false: Charles Ponzi's original 1920 scheme used postal reply coupons, not crypto, and ran on the identical principle: new deposits covering the appearance of returns on old ones. Bernie Madoff's fraud, uncovered in 2008, involved conventional securities. The asset changes. The structure of custody functions secretly funding a bet does not. Myth: regulation would have obviously prevented this. Reality: regulation reduces the frequency and size of this pattern. It has never eliminated it. Traditional banks are regulated and still required government intervention during the 2008 crisis, when off-balance sheet vehicles performed a structurally similar function, hiding leverage from the entities meant to be protected by disclosure rules. Why it's false: the presence of a regulatory framework changes the paperwork failure requires, not the underlying incentive to disguise leverage. When a business is confident, the bet will pay off before anyone checks. Myth: the size of the fraud is what made it dangerous. Reality: size determines headlines, not fragility. Carmen Reinhart and Kenneth Rogoff, in This Time is Different, 2009, documented that financial crises recur in economies of every size and every level of development. Driven less by the scale of leverage than by the shared belief each time that this time is different, that the usual rules of liquidity and solvency don't apply to the current boom. Why it's false: smaller, less publicized versions of the same commingling problem have occurred inside regional banks, savings and loan institutions, and private funds without making international news, and have still wiped out depositors just as completely relative to their size. Myth: the founder's personality explains the outcome. Reality: personality determined the style of the fraud, the informality, the public statements, the eventual unraveling under cross-examination. It did not determine the underlying incentive structure, which existed the moment a single entity controlled both customer custody and a proprietary trading book with no independent check between them. Why it's false: John Kenneth Galbraith, in The Great Crash 1929-1955, observed that speculative episodes generate what he called the bezel, the gap between the funds people believe they have and the funds that actually exist, a gap that grows invisibly for as long as no one has reason to look. The bezel does not require an unusual personality. It requires an unaudited gap and enough time before someone asks a hard question. Myth: sophisticated investors and venture capital due diligence would have caught this. Reality: FTX raised more than $1.8 billion in equity from investors, including roughly $1.1 billion from approximately 90 US-based institutions, according to the SEC's complaint. Many of those institutions were experienced venture and growth equity firms with dedicated diligence teams. Why it's false: due diligence in fast-growing private companies is frequently built around growth metrics, market position, and management credibility, rather than independent verification of custodial segregation, because that verification is harder to obtain the less regulated the jurisdiction, and the more the company controls its own reporting. Institutional sophistication reduces this risk. It has never eliminated it, which is precisely why Ben Bernank's research on the Great Depression, collected in Essays on the Great Depression, 2000, emphasized that even well-informed depositors and creditors routinely misjudge solvency risk when the information required to judge it is controlled entirely by the institution being judged. You cannot audit every institution holding your money. You cannot read every prospectus, every terms of service document, every reserve attestation before it's published. What the historical record gives you instead is a small number of structural questions that have, across 3 centuries of these episodes, reliably separated the institutions that survived a liquidity shock from the ones that didn't. None of these guarantee safety. Together, they meaningfully change your exposure to this specific, recurring pattern. Ask whether the entity holding your deposit is legally and operationally separate from any entity that trades or lends with its own capital. Custody and speculation, combined under one roof, is the single clearest precondition for this failure mode. Check whether your assets are held in a form that is independently verifiable, audited by a firm with no financial relationship to the custodian, using standards that produce a real reserve report, not a press release. Treat any yield that significantly exceeds prevailing risk-free rates as a signal to investigate the source of that yield, not as a reason for confidence. Unusually high returns are frequently funded by drawing down principal from other depositors. Notice when a company's own token, coin, or in-house instrument is used as collateral for its borrowing. An asset priced primarily by its issuer is not independent collateral. Distinguish between marketing transparency and financial transparency. Public donations, celebrity partnerships, and prominent conference appearances are reputational signals. They say nothing about a balance sheet. Diversify custodial exposure the same way you would diversify counterparty risk in any other context. No single exchange, bank, or platform should hold an amount you cannot afford to lose to a liquidity event, regardless of your confidence in the institution. Watch withdrawal friction as a leading indicator. Reinhardt and Rogoff's research on banking crises found that processing delays and shifting explanations for withdrawal slowdowns consistently preceded acknowledged insolvency, often by days or weeks. Understand the difference between an insured deposit and an uninsured one. Deposit insurance schemes exist precisely because the commingling pattern recurs. An asset class or platform without an equivalent protection carries that specific, historically recurring risk by design, not by accident. Read audited financial statements when they exist, and treat their absence as information. FTX operated for years without the kind of audited reserve reporting that regulated financial institutions are required to produce. Remember that a crisis in one asset class frequently transmits into another through shared counterparties. The collapse of the TerraUSD stablecoin months before FTX's failure weakened Alameda's balance sheet directly, illustrating how a shock in a seemingly unrelated corner of a market travels through leverage and shared exposure until it reaches you. Pay attention to who is endorsing a platform and why. Celebrity endorsements, stadium naming rights, and prominent political donations are marketing expenditures funded from the same pool as everything else on a balance sheet. They function as a signal of confidence, not as evidence of solvency, and history shows the two can diverge completely. Recognize that the absence of a public scandal is not evidence of soundness. Every institution examined in this pattern, from the South Sea Company in 1720 to Madoff's fund in 2008, operated for years, in some cases decades, with an unblemished public reputation immediately before its collapse. Reputation is a lagging indicator. Custodial structure is a leading one. You've been shown a pattern, not a monster. That distinction matters more than it sounds like it should. It is tempting to file this away as the story of one unusual person on one island. Filed that way, it teaches you nothing about the next one. Filed correctly, as a recurring structural pattern, a name, a mechanism, a set of preconditions, it becomes a lens rather than a headline. Ray Dalio in Principles for Navigating Big Debt Crises, 2018, argued that these episodes are recognizable in advance to anyone who studies the mechanics rather than the narrative, because the mechanics repeat even when the narrative details, the country, the asset, the decade, the person, do not. That is not a comforting idea in the sense of removing risk from the world. It is a useful one. Because it converts a source of anxiety into a checklist you actually control. The deeper question was never what happened on that island in November 2022. The deeper question is why a version of this has happened, on some island or in some ledger, in nearly every decade for the past 300 years, from the Dutch tulip contracts of the 1630s, to the South Sea Company in 1720, to Ponzi's postal coupons, to Madoff's fabricated statements, to a crypto exchange with a stadium naming deal. The answer each time sits in the incentive structure. Whoever controls both the deposit and the bet gains time, optionality, and liquidity that the depositor believes does not exist until the depositor asks for it back. You will still use exchanges, banks, and platforms. That is not naive. It is how a modern economy functions, and most of them will never fail this way. What changes once you understand the mechanism is what you are watching for, not fear of the next headline, but literacy about the structure underneath it. There is a version of this story told as pure spectacle. An island, a penthouse, a disgraced 30-year-old facing 25 years in prison. That version is emotionally satisfying because it has a villain and an ending. The structural version is less satisfying and more useful because it doesn't end. It repeats in different clothing, in whichever market is least scrutinized and most enthusiastic about itself. Niall Ferguson in The Ascent of Money, 2008, traced this same recurring architecture across roughly 4 centuries of financial innovation, new instruments, new institutions, and the same underlying human tendency to extend trust faster than verification can keep up with it. None of this requires you to distrust every institution you deal with. It requires you to know which 2 questions actually matter when you extend that trust: who controls the custody, and who checks the person who does. The next time you hear about a platform offering unusually generous returns, a company using its own token as collateral, or a withdrawal that is taking longer than it should, you won't just be watching the news, you'll be watching the incentives beneath it. If you want more videos like this, subscribe.